Welcome to GRE. I'm your host, Keith Weinhold. Per conventional measures, today's U.S. economy is strong, but there are four vicious threats on the horizon, and we're not doing enough about them. Our macroeconomist guest will discuss that with us today. How alarming is it, and what's the solution to our crises this week on Get Rich Education?
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Fort Wayne, Indiana to Fort Lee, New Jersey, and across 188 nations worldwide, I'm Keith Weinhold, and you are back inside Get Rich Education. We've been here for you every single week since 2014. Coming off of an election last week, this spurs more macroeconomic thought, monetary and fiscal policy, and more than that. And you know, one thing that I'm always looking for are signs of inflation versus deflation. Because we live in a long-term inflationary world, well, you wouldn't keep $1 million under a mattress because it would only be worth $300K in a few decades. But in deflation, you would flip your strategy and actually be a saver. You might keep millions under the mattress because deflation would actually increase the purchasing power of every single one of your dollars. Now, I've got a pretty unpopular take for you here. At some point, probably now, you've got to give the Fed credit for a soft landing. And what does a soft landing mean exactly? It means bringing down inflation without putting the economy into a recession. Well, inflation is down to about 2% now. Unemployment is still low, near 4%. And GDP growth for last quarter came in at 2.8%. Okay, yes, I sure understand that those benefits are distributed unevenly. But at this point, how much more of a soft landing do you really want? And by the way, this sure doesn't mean that I love the Federal Reserve. I mean, they get no credit from me for not jumping on inflation sooner when it peaked 2.5 years ago, or even before that point. Well, those high consumer prices as a result of that are still with us, and that's a problem, and they got that part wrong. We're about to talk with our global macroeconomic expert. Really, he is one of the foremost authorities in the entire world today. We're going to talk about four major catastrophes the U.S. economic future faces. One of those four is our ballooning national debt and deficit. And to review that for you first, the debt is our overall accumulation of debt over the years, now at $36 trillion. And when it comes to these awful, dreadful debt and deficit issues, I will ask our guests the question, when is it game over? Where is that tipping point? What would need to happen? And the deficit, okay, that refers to the annual shortfall, the annual thing, that shortfall that our bloated government keeps coming up with at the end of every year. All right, so therefore, revenue minus spending equals deficit. Another way to say that is income minus expenses equals a deficit when the expenses are greater than the income. Well, that figure is near $2 trillion. We're spending $2 trillion more than we raise in revenue each year. And here's an example. I'll use real world numbers, round it off to the nearest trillion. So if the government's annual revenue is only $5 trillion, and you have to subtract out spending, which is $7 trillion, That gives us an annual deficit of $2 trillion. Pretty simple stuff. And that more or less gets added onto our overall debt of $36 trillion. Another major problem is this growing competition from China. Yes, I know that people like to discuss their demographic problems, but still, their population is more than 4 times the U.S. population. And you learn about what other advantages they have over us and what we direly need to do to catch up in our guest's opinion. These issues incur some rather detailed explanations, so I'm really going to let our guest expert take over for a while today. This weekend, I will be in San Antonio, Texas. San Antonio is an uptrending real estate market because they are really a beneficiary in distribution with their proximity to Mexico and the nearshoring movement that's taking place. And then I will be in Austin, Texas for a few days. Austin is one of the few major U.S. metros that have seen rents substantially decline recently. I'll bring you next week's show from Austin, where I might talk more about that. Then from the 20th to the 24th of this month, I'll be in New Orleans at the famed New Orleans Investment Conference, where they're pulling out all the stops at the 50th anniversary of the event. And that is the longest running investment event in America and perhaps the world. I hope to meet some of you there in New Orleans, just like I do each time I'm at the event. Let's talk about the bigger picture economy that your real estate and investments float within next. This week's guest is the author of 4 books analyzing the crises that brought the global economy to the brink of collapse in recent decades. One of the books forecasts the 2008 global financial crisis with great accuracy. We're going to discuss future crises here today before we're done. He has worked as an equities and investment analyst, and then he went on to hold some rather esteemed roles at the World Bank in D.C. and as a consultant to the IMF in Asia. He joins us from Thailand today. He now publishes a video newsletter called Macro Watch. And longtime listeners know that today's guest was also this show's very first guest. That was back on GRE Podcast Episode 7, fully 10 years ago now, in November of 2014. And he's really become quite the friend of the show, and we've looked out for each other ever since. Hey, it's terrific to have back global macroeconomist Richard Duncan.
Keith, hey, thank you for having me back. It's great to speak with you again.
Oh, it's so good to have you here. An entire decade of our lives. And as times change, economies are surely dynamic, and you're so good at spotlighting crises and explaining them in a way to people that they can understand. So, Richard, why don't you talk to us now about risks facing the nation? Yes, I'm talking about the United States.
A lot of podcasts focus on all of the problems the United States is facing. And it is certainly true that the United States is facing very serious risk. So I'd like to start off this conversation telling you what I think the greatest risk facing our country are. There are 4 main things I'd like to hit on. The first is something you mentioned to me before in our exchange of emails, is that the U.S. government does have a very high level of government debt relative to GDP, and the budget deficits are large. So that's problem number 1. Problem number 2, in my opinion, looking at this from where I lived in Asia, is that the United States is at risk of being conquered by China in the not too distant future. Risk number 2. Risk number 3, we have very serious domestic political divisions within the United States. Risk number 4 is that our post-capitalist economic system, which I call creditism, must have credit growth to survive. If credit contracts, then our economy will spiral into a Great Depression that will be probably worse than the one of the 1930s. So those are the big 4 problems that we have. And it doesn't do anyone any good just to talk about our country's problems if you don't offer a solution to them. So in my opinion, all of these problems can be overcome by accelerating economic growth in the United States, while all of these problems would be made very much worse by anything that causes U.S. economic growth to slow down. The way to make the U.S. economy grow much faster is to have the U.S. government finance a very, very large investment in the industries and technologies of the future over the next 10 years, starting immediately. The alternative, austerity, would cause the economy to spiral down into deflation. Would like your listeners to think of austerity. When they hear the word austerity, I'd like for them to think of the word death, because austerity is equal to death.
Yeah.
That's not what we want. The U.S. doesn't have to be a declining power. The first American century doesn't have to be the last. It can be the first of many. The solution for driving the U.S. economy to grow much more rapidly and solving all four of the problems that I mentioned above is a U.S. sovereign wealth fund. Thank heavens, both parties now support the establishment of a U.S. sovereign wealth fund. On September 5th, former President Trump came out in support of establishing a U.S. sovereign wealth fund, and on the following day, the Biden administration said they've been working on this for months and had a plan that they were developing. So this is fantastic news for the United States. It offers great hope for solving all of our gravest problems. And I'd like to spend a few minutes explaining to your listeners what a U.S. sovereign wealth fund is.
Yes,
and
please.
Why it's so urgently necessary, and why both parties have now come to understand why this is important to establish.
Yeah, please tell us why you think the U.S. Sovereign Wealth Fund is so urgently needed and what it is. Because for even longer than the 10 years since you were first here, for about 15 years now, you have championed and promoted this U.S. Sovereign Wealth Fund. You discussed it on CNBC's Squawk Box and all over the place. Last year, you presented about it in a speech in D.C. to 15 members of the House Ways and Means Committee. So tell us about the U.S. Sovereign Wealth Fund and why you think it's urgently needed.
Let's begin with what is a sovereign wealth fund. Well, effectively, a sovereign wealth fund is where a country invests in individual companies or even in startups. There are sovereign wealth funds all around the world. Norway has the largest. Singapore has two very effective ones called GIC and Temasek, which have been enormously profitable and successful and have made the people in Singapore much richer. So a sovereign wealth fund in the United States would be an investment fund financed by the United States government with the U.S. This investment fund would take stakes in existing companies and also in startup companies, hopefully on a very large scale. Now, some people have asked, why is this framework necessary? Why do we need a sovereign wealth fund to do that when the government is already making investments in the military, for instance, and funding some R&D research? Well, the difference between what the government is doing now and a sovereign wealth fund is with a sovereign wealth fund, the government would actually keep equity stakes in these companies that they invest in, meaning that when these companies they invest in become enormously profitable, the profits would be owned by every American. The Americans would have the equity stakes in all of the investments that this sovereign wealth fund makes. And it would be a situation where the government provides the financing, but the private sector manages the companies. The government just finances these companies in new industries and new technologies. And the government has the ability to invest on a very much larger scale than the private sector does. For example, the United States has a lot of great companies in the private sector that have accomplished really, truly great things in recent years and long past as well. But these private sector companies cannot invest on the same scale that the Chinese government can. The Chinese government is investing on a much larger scale than any of the American companies could ever dream to invest on. And that explains why China is overtaking us now technologically. And if they continue to invest at a rapid rate that they're doing currently, then before long, they are going to be far ahead of us technologically and therefore economically and more worryingly militarily. The U.S. government has the ability to invest truly on a multi-trillion-dollar scale over the next decade in new industries and technologies, things like artificial intelligence, quantum computing, nanotech, biotech, genetic engineering, and developing energy sources like fusion. And it has the ability to do this on such a large scale that it would be certain to succeed. And once these companies start creating cancer vaccines or fusion, for instance, they would be enormously profitable. and they could be listed on NASDAQ at multi-trillion-dollar valuations. And the American public would own equity stakes in these companies and would directly reap the rewards of these profits that these companies would generate. That is what a sovereign wealth fund is. Why it's desperately needed is, well, first of all, we should do it because we can easily afford to do it. And the results, the breakthroughs, the technological breakthroughs and medical miracles that these sorts of companies would produce would, we really have the shot of curing all the diseases and radically extending life expectancy, developing sources of limitless energy that would bring down the cost of energy radically. Just across the board, it would induce a technological revolution that would turbocharge U.S. economic growth, create undreamt of wealth, and at the same time shore up U.S. national security in the face of this growing threat from China. So for all of those reasons, it is urgently necessary, in my opinion.
Both Norway and Singapore have had similar models to this U.S. sovereign wealth fund, and we certainly think of those two nations as prosperous places. Tell me more about why it's a success. So the government finances it. Does that incentivize companies to therefore take more risk?
It allows them to invest more. It allows them to invest on a much larger scale than they could if they have to rely on their own funding sources. Rather than investing millions of dollars, they could invest billions of dollars or tens of billions of dollars. For instance, at the moment, the National Cancer Institute in the United States, its annual budget is $6 billion a year. $6 billion a year is not curing cancer. If we look back a few years ago, the Fed was creating $120 billion a month through quantitative easing per month. So with just 5% of 1 month of QE, you could double the National Cancer Institute's budget. Now, that's not what this sovereign wealth fund would do, but it just illustrates the scale, how much greater the scale would be that the government could invest on relative to what is currently being invested at the moment by the government and by the private sector combined.
Do any critics ever ask about, well, wait, is this too much government intervention into the free market? Is this a move away from capitalism? What do you say to those sort of critics?
I say to them that capitalism died in World War I. It certainly didn't survive the 20th century. Now, the government in the 19th century, we had capitalism. The government had very little involvement in the economy then, and gold was money. But now, gold is no longer money. The Fed creates some money. Government spending is something like nearly $7 trillion out of a GDP that is around just not quite $30 trillion yet. So the government has been directing the economy going back at least since World War II. This hasn't been capitalism for a very long time. Under capitalism, the private sector made investments, and some businessmen would make profits from their investments, and they would save that profit as capital and reinvest that capital. That's how capitalism grew. That's why they called it capitalism. It was based on capital accumulation and investment. But that's not how our economic system has worked for decades. Our system now is not driven by investment and saving by the private sector. It's driven by credit creation and consumption, and more credit creation and more consumption. And our economy has now been transformed from capitalism. It has evolved into creditism, with the government playing the directing role. So total credit in the United States just last quarter blew through $100 trillion for the first time. By what I mean by total credit is the same thing as total debt. Total credit is equal to total debt. So this is all the debt of all sectors of the economy: the government sector, the household sector, the corporate sector, the financial sector, the Fannie Mae and Freddie Mac, all the sectors of the economy. It just went through $100 trillion. And creditism has created very rapid growth, especially all around the world, not only in the United States, because it has allowed the U.S. economy to grow so rapidly and to import so much from other countries that this is why the Asian miracle occurred. I've lived through the Asian miracle because the U.S. has been running massively large trade deficits since the early 1980s, and all of these countries in Asia have been running massively large trade surpluses. And all of this spending that the Americans have been doing has been fueled by this radically expansion of credit. Total credit first went through $1 trillion in 1964. Now it's $100 trillion, 60 years later. Our system is not capitalism. The government is very involved. Anytime there's any problem with the economy, the government steps in. In 2008, the government prevented a new Great Depression when the private sector, the households, defaulted on their debts and caused all the banks to fail. And Freddie Mac did fail and had to be taken over by the government. So at that time, we narrowly avoided a Great Depression because the government increased its budget deficits by more than $1 trillion a year for 4 years in a row. And the Fed created $3.5 trillion between the end of 2007 and 2014, expanding its balance sheet by about 5 times. So that's not capitalism. We don't have capitalism. So people who are worried about us abandoning capitalism, they're behind the times. That happened a long time ago. That shouldn't be a concern. They should be aware now that we are competing against players who don't play by the capitalist rules of little government intervention in the markets. We're now competing against China. And China is one giant sovereign wealth fund intent on dominating the world by investing very aggressively in new industries and technologies. In the year 2000, the United States invested, I think, 10 times as much in research and development as China did. But now China is actually investing more in research and development than the U.S. is. And that explains why China is ahead in so many areas of technology. They had 5G years before we did. They are the leaders in electric vehicles and batteries. We have to put up 100% tariffs to keep out electric vehicles from China because they're so much better than our electric vehicles. They dominate solar panels, and far worse, they have hypersonic missiles, and we don't. And I'm sure they have other military advantages that we don't because they invest much more aggressively in new industries and technologies than our government does. And if we don't rectify this quickly, then we are soon going to be overtaken by China militarily, and our national security is at risk, much more than most Americans understand. But this realization has slowly grown on policymakers in Washington, and now both parties are worried about this, and this is why we have this growing fear of China and why we have proposals to limit technology transfers to China. And this is why we've done things like the Chips and Science Act, where the government has agreed to finance a $280 billion investment in new industries and technologies a couple of years ago, with $50 billion of that going into setting up manufacturing facilities in the U.S. to create semiconductors, rather than relying solely on Taiwan to obtain all of our semiconductors, because China could take Taiwan at any moment. And then they would end up with all the semiconductor chips that go into powering artificial intelligence. And whoever develops artificial general intelligence first is going to rule the world. And therefore, it had better be the United States rather than China, because we don't want to live in a world dominated by China, believe me.
Well, a lot of macro voices agree with you. About 2 months ago, we had the president of the Mises Institute here, and the way he characterized things are, in the United States, 100 years ago, we had islands of socialism in a sea of capitalism, and today we merely have islands of capitalism in a sea of socialism. Do you see the U.S. Sovereign Wealth Fund being able to solve all 4 of the United States' big problems that you outlined? Debt and deficit, conquering by China, political division, and creditism. Can it solve all 4 of those?
Yes, it can. So as you know, Keith, a couple of years ago, I published my 4th book. It was called The Money Revolution.
Yeah, I know the book. Sure.
Yeah, How to Finance the Next American Century was the subtitle. And I argued that it would be very easy for the U.S. to invest on a multi-trillion-dollar scale in new industries and new technologies over the next decade. And if we do that through a sovereign wealth fund, then would generate so much growth and be so profitable that instead of causing the government debt to increase, it would actually make the economy so much larger and generate so many more tax revenues. And the government would make so many profits from these companies that it has equity stakes in that it would reduce the government debt in absolute terms and radically reduce the government debt relative to GDP, which would grow far faster than it has been growing in recent decades. That's problem number one solved, the high level of government debt and the high level of debt to GDP. Just make the GDP grow a lot faster, and the ratio of debt to GDP will go down. Problem number two is the U.S. is at risk of being conquered by China. We can out-invest China. We can invest more than China can afford to invest. We still have the best universities and the best entrepreneurs and scientists. So if we invest on a large enough scale, we will win, and China will not conquer us. Third, if the economy is growing at 7% a year instead of 1% a year, that is going to alleviate a lot of the domestic tensions that exist currently. Much of the reason there's the origins of this domestic political divide that we're now suffering from in the U.S. is because such a large part of the population has been left behind when all the factories moved overseas. Countries like China and Vietnam, we deindustrialized, and the people who used to have good factory jobs, good unionized, high-paying factory jobs, all those people were left out in the cold, and they're not happy about it. And so if our economy were growing much more rapidly, these people would have much better jobs and much higher salaries, and they would be much happier than they are at the moment. And the final one was our post-capitalist system of creditism requires credit growth to survive. So if the government is financing these investments on a multi-trillion-dollar scale, it's going to make credit expand, and that's going to keep the economy expanding. So yes, it would solve all four of those problems.
One of those four problems is the debt and the deficit. I want to dive into that more with Richard as it becomes more and more problematic in the United States and just how far we can kick this can down the road. You're listening to Get Rich Education. We're talking with macroeconomist Richard Duncan. More when we come back. I'm your host, Keith Weinhold. Oh, geez. The national average bank account pays less than 1% on your savings, so your bank is getting rich off of you. You've got to earn way more, or else you're losing your hard-earned cash to inflation. Let the liquidity fund help you put your money to work with minimum risk. Your cash generates up to a 10% return and compounds year in and year out instead of earning less than 1% in your bank account. The minimum investment is just $25K. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And you know how I know? Because I'm an investor in this myself. Earn 10% like me and GRE listeners are. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866. Hey, you can get your mortgage loans at the same place where I get mine at Ridge Lending Group, NMLS 42056. They've provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is author Jim Rickards. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We are going big this week, talking about the global economy, although mostly centered on the United States, with macroeconomist Richard Duncan. You can learn more about him at richardduncaneconomics.com. And Richard, I want to talk about the debt and the deficit. The debt is the United States' overall debt as it accumulates year after year, and the deficit is just the annual thing. And it's so interesting and concerning when I look at this. When you look at the line items in the United States government's annual spending, we now see that interest payments are taking the second largest chunk, only to Social Security. Social Security is number one. Interest is the second biggest expense, even more than defense spending and on Medicare. So I just wonder, as I see the interest payments going up and up and up, and projected to be our greatest expense every year. One thing I think about, Richard, is when our interest payments alone exceed our revenue somewhere down the road, is that when it's game over, or is that when we're on the way to game over? So can you talk to us about really where the concern crops up with the deficit like I talked about, and with the debt that's now at about $36 trillion?
Deficit and debt is a real problem. It was the first problem that I mentioned when we kicked off the conversation. There are two components of that. One is the fact that government debt has been increasing very rapidly. At the end of 2007, total government debt was around $9 trillion. By 2014, it had doubled to $18 trillion because the government had to respond to the collapse of the private sector in 2008 and prevent us from having a Great Depression at that time. And then after 2014, it has doubled again from $18 trillion to $36 trillion now. Much of that was due to the need for the government to keep us from having another Great Depression during COVID, when government stimulus amounted to about $5 trillion, and the Fed created a similar amount over just a 2-year period. So now we have a much higher level of government debt. But the second component of that is that interest rates are very much higher than they used to be. The federal funds rate went up from 0% a few years back to a high of 5.25%, actually a range between 5.25% and 5.5%. And recently the Fed cut the federal funds rate by 50 basis points. But you can still say it is 4.9%. Let's call it 4.9%. So interest rates are far higher than they used to be, but they don't have to remain high. The reason interest rates went up is because the Fed increased the federal funds rate. And the reason the Fed increased the federal funds rate is because we had high rates of inflation. Inflation peaked at 9% or so in 2022. But most recently, the CPI has come back down to 2.4%. And the Fed's favorite measure of inflation, the PCE price index, has come down to 2.2%. And that means that the federal funds rate, which is 4.9%, is more than twice as high as the inflation rate is. That shows us that we have very tight monetary policy. And the Fed should be able to reduce interest rates very rapidly going forward. They've told us in their dot plot projections that they expect that interest rates will end this year, the federal funds rate, at 4.4%, and then in next year at 3.4%, and 2026 at 2.9%. So that reduction in interest rates will bring down the cost of the total interest expense that you mentioned as being so high currently. The risk, however, is that we get a rebound in inflation. Were inflation to surge again, then interest rates won't come down. In fact, they could go higher. So all of my career, more or less, has been spent in Asia. And the main theme that has run through the global economy, the development of the global economy over the last 3.5 decades, has been globalization. Globalization in the form of the U.S. running very large trade deficits with other countries. Literally, the U.S. current account deficit since the early 1980s has been $15 trillion, meaning countries with the trade surpluses have had a $15 trillion trade surplus. And that's why they've all been transformed economically as a result of their trade surplus with the U.S. But what the U.S. got out of this was the ability to buy things made with very low-cost labor, and that was extremely disinflationary. That drove down the inflation rate in the U.S., and that allowed interest rates in the U.S. to come down to very low levels that we've seen during most of the century up until the time COVID started. The real danger is now if we do impose very high trade tariffs on China and our other trading partners, then that will cause a very serious spike in inflation. And it won't just be one-off because, of course, when the tariffs are put in place, that will immediately cause everything to be that much more expensive. The U.S. companies importing goods from abroad would have to pay that tariff. Then those U.S. companies would pass those higher expenses on to the consumers. So we'd get an immediate spike in inflation. But that would also mean that the companies abroad, it wouldn't be so profitable for them to have their manufacturing facilities abroad. They would try to bring those back home. And given that the unemployment rate in the U.S. is so low already, only 4.1%, there's not enough labor to allow these manufacturing facilities to come back to the U.S. and start producing goods in the U.S. So that would cause an upward spiral in wages and a wage push inflation spiral of the type that we had in the late 1960s and early 1970s. So that is in other words, tariffs would put an end to globalization, and that would cause such a severe spike in inflation and interest rates. It would essentially be the death knell for creditism, which requires credit growth to survive. End of globalization would mean this end of this 30-year global economic boom that the world has enjoyed, and therefore it is a very severe threat, and it would push up the interest expense of the U.S. government, which you led off with. Instead of lower interest rates bringing down the interest expense the government has to pay every year, we would have instead higher interest rates, which would make the amount that the government has to pay on its interest even higher than it is at the moment, and make the budget deficit even larger than it is at the moment, and make the government debt grow even faster than it's growing at the moment. So let's hope that doesn't happen. Instead, the better approach is to invest, to have the government finance large-scale investments in new industries and technologies, make the economy grow much more rapidly, and we can grow our way out of this debt problem that we're currently in.
Yes, more inflation, whether that comes from higher tariffs or any other sources, will lead to higher interest rates to counteract that higher inflation, which will, yes, pump up the deficit and the debt that much more. And, one thing that I like about Richard is, a lot of people complain about things or say, what are we going to do? Or things look bad. And Richard is saying some of that, but he offers a way forward with the U.S. Sovereign Wealth Fund, like he talked about before, investing our way out of it. So, Richard, if we don't invest and this debt and deficit situation gets worse, it could be a hard question to answer, but I'd like your best guess at how far can we kick the can down the road? When is it game over? How big do our interest payments on the debt and deficit have to get?
The game is never over. No matter how bad things become, humanity will survive and carry on. So even in the Great Depression, people made it through. Even through World War II, that resulted largely as a result of the Great Depression. A lot of people died. 60 million people died, but the game didn't end. So regardless of how bad the economic system were to become, humanity will survive, and there will be a solution. Now, a lot of people put forward the idea that they point out that we have this high level of government debt, and their solution is to reduce government spending. The government spends something like $6.8 trillion last year. That was the amount the government spent. The budget deficit last year was $1.8 trillion. So in order to eliminate the budget deficit, the government would have to spend $1.8 trillion less. In other words, it would have to cut its spending by 27%. If the government cut its spending by 27%,
not going to happen.
The economy would immediately spiral into a depression. So even that reduction in spending wouldn't balance the budget, because the government revenues would collapse, and they would have even fewer tax revenues. So the deficit would still be there. The economy would collapse, and the unemployment rate would be 20+%, and would just fall further behind China and be at greater risk from a national security perspective, and much more miserable as a society overall. That's why I always say people should think of the words austerity and death at the same time, because austerity would bring about the collapse of our economic system and the Great Depression. I'm not sure our civilization would survive it.
Gosh.
Try to answer your question more directly. How high could this go? Well, governments don't default on their debt. When push comes to shove, if the government's having a hard time paying interest on its debt, the Fed will just print more money. And in a case where between 2008 and 2014, when the Fed created $3.5 trillion, they printed a lot of money at that short space of time, and they got away with it without having high rates of inflation. The highest rate of inflation we had during that period was 3.8% in 2011. And by the early months of 2015, we had deflation again for a few months. Prices actually fell, negative CPI for a few months in 2015. So if we have a global economy, as we do at the moment, we have nearly 8 billion people. I would guess 2 billion of them at least live on less than $5 a day. So the U.S. could get away with having a lot of paper money printing without having very high rates of inflation. And the government could finance itself that way for quite a long time. Of course, if we have a closed domestic economy brought about by extremely high tariff barriers, then we would end up with hyperinflation in the United States. But even with hyperinflation, it would be very painful for people who have all their cash in the bank or under their mattress. But people with assets, those asset prices would appreciate more or less in line with the inflation. And it would erode the government debt relative to the size of the economy, because the GDP would grow in nominal terms very rapidly because of the hyperinflation. And the debt, which is not inflation adjusted, would be evaporated away by the inflation.
Right. That's why here at GRE, we are all invested and aimed toward prudent use of leverage with assets like real estate. And we sure have been the beneficiaries of that wave of inflation that followed COVID there, Richard. Well, now we're talking about the debt and the deficit somewhat, which interestingly has actually doubled since the first time you were here on the show. When you were here 10 years ago, it was at 18 trillion, and today it's at 36 trillion. We talked about how far can you kick the can down the road back then. Well, here we are 10 years later, and it's doubled. Talk to us, you talked previously about the greatest risk to the United States economy. Tell us now, as we are investors here on this show, about the greatest risk to the real estate and stock market, I'll just say within the next year. What are some of those risks to those particular markets?
We've already discussed the main risk, that high tariffs would potentially cause a new spike of inflation and force the Fed to hike interest rates rather than cutting interest rates. But there are some other risks as well. One is the fact that we already have a very high level of wealth relative to income. Let me back up a second. You were talking about debt doubling since we first spoke 10 years ago. Here's another statistic for you. Just in the last 4.5 years, the total wealth of the Americans, all of their assets minus all of their liabilities, in other words, household sector net worth, since the end of 2019, it has increased by $47 trillion in 4.5 years. That's about a 40% increase. Now, $47 trillion is enough to pay off the entire U.S. government debt, which we've been worrying about, with $11 trillion left over. So not everything is as bleak as it sounds on the surface. We've had a huge explosion of wealth in the last 4.5 years that's been driven by property and also by stocks. The problem now is that the level of income, the asset prices are very inflated relative to their historic norms. And one of the ratios that I always keep an eye on is called the wealth to income ratio. It takes the household sector net worth, in other words, wealth that we were just discussing, which, by the way, is now $164 trillion of wealth owned by the Americans. The wealth divided by income, disposable personal income. This wealth to income ratio is now an extraordinarily high level. The ratio is 785%, whereas the average for that ratio going back to 1950 has been 550%. The previous two peaks were in the year 2000 when it hit 620 during the NASDAQ bubble. And then that bubble popped and the stock market crashed and we had a recession and it went back to 550. And then it surged to a new peak of 680 during the property bubble. And then that bubble popped and we almost went into a depression and that a lot of wealth was destroyed. We had a severe recession. The government had to bail us out from, and that ratio went back to 550 again. Now it is just off the charts relative to its previous peaks.
Yeah.
Previous peak was 680, now it's 785. So people used to suggest that higher asset prices were justified because interest rates were near 0%. But even after the Fed hiked interest rates from near 0% to above 5%, the asset prices have stayed inflated. So that does suggest that asset prices are very inflated and therefore very vulnerable to any sort of shock that could occur, whether geopolitical or economic or domestic political problems. So that's a concern. Another concern is quantitative tightening is still occurring. Quantitative tightening is the opposite of quantitative easing. When with quantitative easing, the Fed creates money and pumps it into the financial markets, and that tends to make asset prices go up. And it also tends to make interest rates on government debt stay low, because if it pushes up bond prices, it pushes down bond yields. Well, now the opposite is occurring. Over the last 2 years, the Fed has destroyed roughly $2 trillion. It created $5 trillion from the end of 2019 till about 2022 during the COVID pandemic and the policy response to that. The Fed created $5 trillion, but now it's destroyed $2 trillion of that $5 that it created, and is still destroying dollars at the rate of about $60 billion a month or $700 billion a year. And as it does, as it destroys dollars, it takes dollars out of the financial system, which, all other things being the same, tends to make financial conditions tighter, putting upward pressure on bond yields and downward pressure on asset prices. So as this continues, this is a concern because it reduces the liquidity in the system by another $700 billion if it continues for another year. Having said that, there is still an enormous amount of excess liquidity in the system as a result of all of the money that the Fed has created going back to 2008. I estimate that the excess liquidity is somewhere around $3.5 trillion if you look at bank reserves and the reverse repos at the Fed. It's about $3.5 trillion of excess liquidity. And the Fed actually has to pay interest to the banks on their bank reserves to hold interest rates up. That's how the Fed controls the federal funds rate now. It pays the banks roughly right now 4.8% interest on all of the banks' bank reserves. And so the banks will not lend money to anyone at less than 4.8% interest because the Fed will pay them 4.8% interest. Why would they lend to anyone else for less?
Right?
If the Fed suddenly stopped paying interest on these bank reserves, these banks would look around and where would they invest their $3.5 trillion in? No one's going to pay them 4.8% or even 3.8% or 2.8%. Interest rates would plunge because of all the excess liquidity that exists. So this excess liquidity has been the thing that's been driving the economy since COVID started, and it's why we've managed to avoid recession, which everyone is expected to arrive at any moment now for the last 2.5 years. So there are concerns, but there are also, as always, other reasons for optimism.
Well, that wealth to income ratio that Richard talked about, that's a calculation that you yourself can do. One's net worth is almost 8 times their income now, which is at a historic high, which is one concerning point that Richard brought up. Well, Richard, I want you to tell us about your terrific video newsletter, Macro Watch, unless you have any other last thoughts first.
Well, just one last word on the U.S. Sovereign Wealth Fund. Thank you very much for giving me a chance to discuss that and to explain why both Democrats and Republicans are now in favor of establishing a U.S. Sovereign Wealth Fund. It's one of the few issues that has bipartisan support, and this must come as a surprise to many of your listeners and most Americans, in fact. Why have both parties agreed on setting up a U.S. Sovereign Wealth Fund? So I'm glad I've had a chance to explain it and why it's so urgently necessary. I'd just like to emphasize the extraordinary benefits that this would deliver to the American people, both individually and at a national level. Individually in terms of medical breakthroughs and much better health and much more rapid economic growth for the economy, so much more wealth and much more national security as well. So I hope the Americans will get on board with this idea and give it their full support because it's exactly what our country needs to solve all the 4 issues, the major issues that I laid out at the beginning of this conversation. But with that said, if your listeners would like to learn more about my work, Macro Watch is a video newsletter. Every couple of weeks, I upload a new video discussing something important happening in the global economy and how that's likely to affect the stock market, property, currencies, and commodities. They can find Macro Watch on my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. Macro Watch has been going on now for 11 years. They'll find more than 100 hours of videos in the Macro Watch archives that they can begin watching immediately. And they'll receive a new video every couple of weeks. And I'd like to offer your listeners a subscription discount. If they go to richardduncaneconomics.com and hit the subscribe button, they'll be prompted to put in a discount coupon code. If they put in GRE they can subscribe to Macro Watch at a 50% discount.
That's great.
That's GRE. So I hope they'll check that out. And at the very least, they can sign up there for my free blog and follow my work that way.
And I have benefited from consuming Macro Watch content myself over the years, allowing me to sort of stretch my thought process and go macro, which we don't always do as real estate investors. Oh, Richard, it's been valuable as always. And you really offered a solution, a way forward here, something that's really refreshing. It's been great, as always, having you back on the show.
Yeah, thank you very much. I look forward to the next time.
Me too. When it comes to the term capitalism, if that's truly a system that we're no longer in, it seems to get replaced with the word meritocracy. And that is a word that I like, meritocracy, where producers get rewards for being productive, but even that is under attack. And the government just always seems to be stepping in with a safety net, seemingly everywhere you look. It won't let banks fail. We saw them jump in early last year with Silicon Valley Bank and other bank failures. The government won't let homeowners fail either. I mean, you don't have to think back very far with mortgage loan forbearance in the COVID era. On issues of the debt and deficit, even Fed Chair Jerome Powell himself has called it unsustainable. That's the word that he used. Like Richard said today, we won't default, we'll just print more. So when it comes to the inflation versus deflation tug of war, the future keeps looking inflationary. But at what rate of inflation? That's what I don't know, and no one really knows. If you like Richard Duncan's content and you sort of wished he and I's conversation would go on, well, he is a regular guest here, so I expect him back. But if you're telling yourself, I want more of his content, and I want to make it visual at the same time to help really bring this to life, well, visit richardduncaneconomics.com, hit the subscribe button, and get 50% off. That's 50% off with the discount code GRE. Happy Veterans Day. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.